Hello everybody, this is Luke McCarty with McCarty Wealth, and this is our September 2025 market update. The theme for September is to stay positive. When you look at market seasonality, September is typically a lower month. I'm going to give you some reasons why we think September will continue to stay positive and push us to new all-time highs, along with the fact that there's over $7 trillion in cash still on the sidelines. We talked about this in a video or two ago in regards to FOMO, fear of missing out. This has been I'd say, a hated rally off the bottom. There's been a lot of naysayers and a lot of reasons not to buy into the market, and it keeps going higher. There will soon be a flood of money into the markets as people have missed out and they want to catch in on the rally. So stay positive in the month of September and through the end of the year. Here is how some of our indices have performed year to date through September 4th. When you look at the S&P 500, it's up about 10%. On the year, the Dow's up about 7%, the Nasdaq is up closer to 12%, and the bond index is up about 2.7%. So you can see the dip back from April from tariffs, and we've climbed out of those and have had a pretty steady rise up to the right in the chart patterns. And then the bond component down on the bottom right corner, the bonds have kind of been chopped around, but we feel that the Fed is going to cut rates this month. And when the Fed cuts rates or when interest rates fall, the price of the bond that you currently own rises in value. So we should see the bond market start to perform better, along with small caps, financials, Mag 7. We'll get into some of those as well. So here are some reasons why we think the stock market deserves a higher market multiple. So currently, the market multiple, the forward PE looking ratio, is lower than it was in 2020. And if you think of what happened since 2020, right, the market has sustained almost 6 black swan events. 2020, we had the COVID shutdown. 2021, there was the bullwhip supply chain. 2022, you had your inflation cycle. 2022 and 23, you had the fastest Fed hikes in history. April 2025, you had the tariff disruption. And then most recently, June of 2025, the USA bombs Iran. These could have all been catalyst for a down, negative, bear market. Of course, some of them had some short-term transitions from bear markets to bull markets, but they've all overcame, and this is why we think the market is staying resilient, along with the Federal Reserve is now printing money again. So the M2 money supply, I talked about this in a video a couple weeks ago, that the money supply is increasing again. If the Fed's on our side, don't fight the Fed. There's a lot of reasons it could have been negative, but the market stays resilient and keeps pushing higher. Here's a chart on the Fed and interest rates from JP Morgan. The gray lines is the Fed funds rate going back to 1993. The blue line is the FOMC year-end estimates, and the green line is the market expectation. So you can see here the Fed funds rates at 4.38. Both the market and the Fed expect it to go down to 3.9% by the end of the year. So that is about 2 rate cuts of 0.25% each. Then into next year, the Fed is kind of thinking, hey, we're only going to cut maybe 1 or 2 times. The market thinks the Fed's going to cut more. So we'll see how those play out over time. But essentially, the market and the Fed are on the same path to cut rates as early as this month and maybe cut 1 more time through the end of the year. And the Fed has now been on hold for the whole year with expectations to cut this month in September. This has only happened 2 other times where the Fed was pausing the whole year and then their first rate cut was in September. And in September of 1998, after this cut, the market was up 6.2% for the month. And in September 2024, after this first cut of the year, the market was up 2% for the month. So September of 2025, assuming the Fed cuts interest rates, we'll see where this ends up, but we feel it is a positive event for the markets, a positive for the economy, for interest rates to start to fall. On Wednesday, September 3rd, 2025, Fed Governor Christopher Waller, he is a voting member of the Fed, so he votes on interest rates. He's also probable outcome to be the new Fed chairman for Jerome Powell. But he said this in an interview with CNBC Squawk Box. You can go to cnbc.com and watch this. But he said we can kind of see where things are going because people are still worried about tariff inflation. I'm not, but everybody else is. He also reiterated that the Fed should start cutting rates as the labor market is weakening. When I saw this, it was interesting because just this last week I put out a video to our YouTube channel and our Facebook channel saying that my personal opinion is I do not feel that tariffs cause inflation, and it is the M2 money supply and the Fed. Well, he's not blaming himself for the Fed and the M2 money supply, but he's also not saying it's tariff related. So Interesting, now we're starting to get some more outlets saying that, hey, tariffs don't cause inflation. It could just be a short-term transitory type of inflation on certain goods, certain products. Here's how we are positioned for upcoming rate cuts. So we still want to own the Mag 7, still want to own the biggest of the best, companies in the world, Microsoft, Meta, Google, Nvidia, Apple, Amazon, Tesla. Most of them have all performed well this year. Google most recently had some good event, a good win, and a strike down from the court that said that they did not have to sell off Chrome. Good for Google. Google's now at all-time highs. Nvidia is the over 4 trillion market cap, the largest company by stock market weighting in the world. So we want to keep owning the Mag 7. We also want to own financials. In some of our portfolios, we own JP Morgan. The same thing happens to the bond portfolio when interest rates fall, right? The price of bonds go up. Well, banks own a lot of bonds. Banks own a lot of treasuries. So when rates fall, the value of what they currently own goes up. So we see a big catalyst for, financials to do well in an interest rate cutting environment. And also small caps. You should see this throughout our portfolios, but SDVY, it's the First Trust Small and Mid Cap Rising Dividend Achievers ETF. This screens out a lot of small cap companies that aren't profitable. So these are small cap companies that have profits, that pay dividends, and when interest rates fall, small caps can then borrow money cheaper to grow. So we like the Mag 7 financials and small caps as we get into the end of the year and as we get into 2026. Thank you everybody for listening. I'm Luke McCarty with McCarty Wealth. Contact us with any questions you have.